Hi, I'm Jeff Lovell, a staff accountant with AA Accounting, and today I wanted to discuss some of the exemptions to the 10% early withdrawal penalty on retirement distributions. Congress enacted a 10% penalty, which is on top of any income tax that is due on distributions from qualified retirement accounts, in order to discourage taxpayers from liquidating their retirement savings during their working years. For this reason, you're only subject to the penalty on distributions that are made before you turn age 59 and a half. However, there are many exemptions. I want to point out at the beginning the kinds of reasons why you might take the money out that don't qualify for the exemption. These include things like paying personal expenses, buying personal property, like say a car, paying down credit cards, mortgages, home equity, other types of debts, starting a business, loaning money to others or giving them gifts, or donating to charities. Payments from a pension or 401k that are received after you turn age 55 that are the result of a job loss are exempt. So are payments that are diverted from a pension or 401k to a former spouse pursuant to some divorce decree by a judge. Payments that are made as an annuity, in other words, in fixed amounts made at least annually based upon your life expectancy, are exempt. However, if those payments are coming from an employer-sponsored plan, then you must no longer be working for that employer. If your retirement accounts are liquidated by the IRS in order to satisfy a tax debt, that's also exempt from the 10% penalty. If you are considered disabled for tax purposes, you don't have to pay the penalty. In order to be disabled, you must have a medical or physical condition that renders you unable to work and also either is likely to result in death or is expected to be of a long, continual, or indefinite duration. Also, in the year that you die, the penalty exemption is waived, except for modified endowment contracts, which are a type of life insurance. Another example is if you turn 59 and a half during the year and the insurance company or broker incorrectly codes the tax form indicating that you would be subject to the penalty. You're only subject to the penalty for the distributions that are made before you turn 59 and a half. You can also reduce the penalty that you pay by any deductible medical expenses that exceed either 10% or 7.5% of your adjusted gross income. But it's important to point out that you can't double dip. So if you use medical expenses to reduce your penalty, you can't also deduct them on Schedule A as an itemized deduction. Also, if you're unemployed at any point during the year and you pay premiums for health insurance for yourself or your family, you could reduce the penalty by that amount. And if you're paying any higher education expenses for yourself or family, again, you could reduce it by that amount, but you can't double dip. So if you're going to use those college expenses to get a tax credit, then you can't also use them for this. And then the first-time home buyer is a situation where up to $10,000 of any house you buy as a first-time home buyer, you can apply against this distribution to lower the penalty. If you have questions regarding the topics covered in this video or any other tax or accounting questions, give us a call at AA Accounting. Call us today to set up an appointment to discuss your tax situation with one of our tax experts. We can help.